All right, Daniel, welcome in. We're going to do a little kind of on-demand webinar here. This is kind of our first iteration of doing one together, so I'm looking forward to it.
Yeah, we talked about it recently on the Nest Egg podcast and video that we do each week for folks that aren't on our email list yet. And I know there's been some excitement and people waiting for us to get this out. So finally getting to it. So we're excited today to knock out the first on-demand webinar.
Perfect. All right, I'm going to pull up our slides here, and we're going to talk through this. Obviously, we're talking about Roth conversions today, and we've mentioned and kind of teased Roth conversions and said, hey, reach out to us if you want to talk about Roth conversions. But there's been a lot of questions that we've gotten throughout this process about what is a Roth conversion? Does it make sense for me? And I think some people think it makes sense for them and it doesn't at all. And some people have no clue about Roth conversions and just don't know to ask. So I wanted to we put this slide deck together and we just really want to kind of go through everything for people. So Daniel, what is your introduction to Roth conversion? What is the main point of what we're talking about?
Yeah, absolutely. Our first primary goal today is really to walk people through how we think through the Roth conversion process. So, how we are going to kind of approach that, some of the math behind it, when it makes sense, when it doesn't, so that you can understand a little bit of kind of how we're going to walk through that with you and in those conversations with you. Or if you're not working with us, how your advisor should be doing that, or how you can do that with us if we don't work with you yet. So that's kind of the goal today, to kind of introduce you to a little bit of why maybe we would do this and then how we will think through it.
Perfect. And the main gist that we're talking about is really that you want to pay taxes now to pay less taxes in the future, right? That's kind of the gist of what we're talking about. But I know there's 57 million things that could happen. So what does this disclosures page say?
Certainly. So, yeah, again, this on-demand webinar is for educational purposes. So we're here to educate. This is not personal financial advice. So we're talking to you through a pre-recorded webinar, which means we don't know your individual situation. And at the end of this information on the last slide, we'll have a way for you to contact us, an email address that you can submit for more information. And we would love to work with any of you personally. So whether you are currently a client of ours, or interested in becoming a client, we're happy to review your information to look and see if some of these strategies may be a fit, but otherwise consult your own investment advisor if you're not already working with us.
Perfect. All right. So, Daniel, before we kind of really dive into what a Roth conversion is, speak on the accounts that we're talking about. So, we're talking about a traditional IRA versus a Roth IRA. Speak a little bit more to that. Speak to the tax implications of both and kind of maybe the traditional method of putting money into either of these categories as a contribution.
Yeah, this may be remedial for some who are watching this webinar, but the fact is, before we get into converting and strategies for taxes and so forth, when we're talking about IRAs, it's very important to go back to the fundamentals and make sure that we are all on the same page of what is a traditional IRA or what is the Roth IRA, what are the benefits of both. And so really simply here, we have it laid out pretty straightforward, right? So traditional IRA, just a reminder there, when you put money in, it is deductible in the year that you make that contribution. Then your funds grow tax-free between now and the time that you take them out, but you are taxed on the withdrawals later on in retirement. So tax-free going in, tax-free growing, but taxed on withdrawals. Roth IRA is effectively the opposite. So you're putting money in today, that's not deductible, so you're still paying taxes on those funds. The funds still grow tax-free, but there is no tax on the withdrawals. So we can obviously see that the key question when it comes to which type of account to utilize in any particular circumstance is really, when do you want your tax benefit, right? We can see very clearly in that table there, the key difference between these two types of accounts is really when that tax happens.
Yeah, and I think this page goes a little bit more into detail there when you're looking at an actual scenario for a contribution. per se. So if you were to contribute to an IRA in, let's just say 2022, you're doing a regular contribution. We're not talking about conversion here. You're doing a regular contribution, and you put in the maximum if you're under age, I believe 50 it is. So you have $6,000 that you put into your traditional IRA. The equivalent to that, if you said that you are paying in a 25% tax bracket or you're saving 25% on taxes right now, would be about 4,500 that you're putting into your Roth IRA this year. So you're getting a $1,500 tax deduction right now by putting it into your traditional IRA. Daniel, you just correct me if I say anything incorrect here, but
No, you're absolutely right there. And I think people will get a little bit tripped up because we basically put two different amounts into an IRA here, right? But we'll get to that in a moment. In the standard IRA, we put 6,000. The Roth IRA, we put 4,000. But it's important for people to note the net effect on the front end in each of these scenarios is exactly the same, right? So the IRA individual here, they put 6,000 in, but then they got a $1,500 tax deduction because of their 25% tax rate. So the net effect really to their financial picture on the front end was $4,500. Roth IRA, the same thing. So we basically just equalize it on the front end, right? $4,500 on the front end.
Right. Yeah. So then we had growth. We showed what happened when you had growth in that account, where you had a 8% growth rate each year for about 20 years. So you can see in this chart where those growth rates are. But then when you get to retirement or whenever you're taking those funds out of the IRAs, you have to be past age 59 and a half in most circumstances. If you're at the same tax bracket when you take it out, you'll see that your net effect at the very bottom here is exactly the same because you pay 25% taxes on your withdrawals of the money that you originally put in. So you pay about $7,000 in taxes with the traditional IRA. You pay $0 in taxes because you paid them initially in the Roth. And effectively, your net amount that you take out is $16,474 in both cases. All right, so Daniel, walk us through this second scenario where we have different tax rates. So say that you have a 25% tax rate whenever you start and you initially contribute, the same as the situation before, but when you're pulling the money out, it's actually a lower tax rate.
For sure. So what we wanted to illustrate here is the fact that it's really that tax rate or the change in the tax rate over time or where that change takes place that is really the important part. So you'll see here, those top two lines, the contribution and the tax deduction are exactly the same as they were on the previous side. So we basically have a net $4,500 impact to your financial picture on the front end. In the IRA, we had a $6,000 contribution, but a $1,500 tax deduction, which means that there was a $4,500 net out of pocket. The Roth IRA, the same thing, just a straight $4,500 net out of pocket because the tax has already been paid on that. The 8% growth is still the same there, but in this instance, we see that this individual's tax rate has gone down in retirement rather than stayed the same. So the tax rate line on the withdrawals is lower, which means that the net available to the client is actually higher because the tax rate in the future is lower than the tax rate now, which illustrates really perfectly of why people would choose a traditional IRA or a tax deferred retirement savings over a Roth IRA in some instances, because the tax deduction now can be much more valuable than the tax deduction in the future. Now, I will say that this is all things being equal, right? So it's excluding things like the taxability of Social Security. It's excluding things like the withdrawals happening over multiple years, et cetera. The point of this illustration is all things being equal, the tax rate change is really what is going to make the effect on whether the IRA or Roth IRA is the best option for anybody. It's not sort of a which do you feel is better, or is there a rule of thumb that for people at certain ages one is better than the other? It really comes down to where is the tax rate change going to happen over time in any particular individual's life.
Yeah, and we don't have a breakdown of what it looks like on the other side. If you had a 25% tax rate whenever you're contributing, but you have a 30% tax rate later on, but it's a very similar situation. The Roth would be more effective if your tax rate is higher in the future than it is when you're doing the contributing. But now we're going to kind of flip that script. We're not going to talk about contributions anymore. We're going to dive into a conversion, the second way that you get money into a Roth IRA. And a conversion is when you take money that's already in your IRA, you pay taxes on it in the year that you do the conversion, and you move it over to a Roth. So, Daniel, start off with the basics as far as what taxes look like over time and why anyone would consider doing this in any circumstance.
Sure. I think one of the things that we often think about when we think about tax rates as individual taxpayers, right, is we kind of assume we're in sort of one tax rate when we're working, and then we retire and we're in a different tax rate. So most of us in our mind go sort of our working tax rate is here, and then all of a sudden I'm going to retire and it's way down here. And so I might as well take a lot of deductions now, and eventually I'll be in a lower tax rate, and I really won't have to worry about taxes anymore. But the fact is that your tax picture is pretty dynamic over your entire lifetime. So you'll see this is a snapshot from our actual planning software where we're modeling tax rates over time, or the effective tax rate for this particular couple's plan. And so you'll see that right now in sort of their working time, their effective tax rate is between 15 and 20%. They still have incomes coming in, they're still paying state taxes, et cetera. But as they retire, they're able to live off of some taxable investments and so forth early on, as well as probably some Social Security, resulting in an extremely low tax rate at the beginning of their retirement journey until eventually their required minimum distributions kick in later on in their retirement. And this is the age at which the IRS gives you very minimal opportunity to tax plan. Now, all of those funds that you've put into your tax deferred accounts, the IRS is going to require a certain amount to be taken out each year. You're going to have less opportunity to tax plan. And you'll see that because of the increasing amount of those RMDs over your lifetime, that tax rate actually ends up drifting higher and ending up roughly in this particular instance, the same, if not slightly higher than it was during those working years. So the old adage that you're going to kind of be at one tax rate now and then be a substantially lower tax rate in the future might not actually hold out. But it's actually this trough in the middle that we're most excited about.
Right. Yeah, that's where we're looking at doing the Roth conversion. But you're right. The government didn't say at age 72, you have to take money out. You have to do your required minimum distributions. Well, then these Roth conversions might not be as effective, or they may be using them for some of the other benefits that we're talking about later. But really, that age 72, when you have to really start taking out significant funds out of your IRA and paying taxes on it, that's what we're trying to initially plan for. And seeing those tax brackets kind of do their valley motion there is what we're looking at. So, all right, Daniel, walk us through this. Walk us through kind of Social Security, the required minimum distributions. I know you just mentioned this. Is there anything else you want to mention on this slide about it?
Yeah, so we touched on a little bit, right? Most people are going to assume that substantially lower taxes in retirement, but the factors that go into that just simply not being the case is the fact that you're going to start earning Social Security. And for most of our clients, 85% of that is going to be taxable. So that's going to be added income to your taxes that you may not actually mentally be thinking about right now. You might just be thinking about your retirement account distributions, et cetera. But also, those required minimum distributions will really come into play. It doesn't matter if you want to take the funds out of your retirement accounts at that point in time. The IRS says this is the amount you need to take out per year. And there's really very few ways around that. And we'll actually probably do another talk sometime about how charitable giving is one good option. We actually addressed it on the Nest Egg podcast just this week. But beyond that, there's very few other options to get around this required minimum distribution.
Yeah, for sure. All right. So this is also it's something that we pulled from our planning software. It's something that we look at with anybody that is even remotely eligible for doing a Roth conversion, because this is a look at your tax brackets over the years. It's kind of another representation of that graph we just looked at. But what you'll see here is this blue coordinates with the blue that we saw on the previous slide, where this is your tax rate if you did nothing. if you basically had you didn't do any Roth conversion and you lived off of, again, like Daniel said, a couple years of some taxable income where your income is very low in these few years. So this green shaded region here is what we're going to be talking about for the rest of the meeting here today. So Daniel, explain these tax brackets and the lines. And this is kind of a confusing graph. So walk us through there.
Yeah, this looks like something that came out of a doctor's office, but it's not as confusing as it looks at first sight. So it's exactly the same graph that we looked at before. It has the income coming in at various ages of this particular financial plan. And then you'll see some colored lines that go horizontal across the graph, starting with the 10% tax bracket, then moving up to something that looks like a 12 to 15% tax bracket, and finally a 22 to 25% tax bracket. And all we're really doing is we're overlaying the estimated, again, it's estimates. We don't know what's going to happen with taxes at any point in the future. Legislation can change that. But based upon what we know today, all the legislation that we know of, we can estimate where income will fall in these particular brackets over time. And so one of the most important things that we can do is fill the lower tax bracket buckets to pay a lower amount early on throughout your retirement. And you'll see that's the green shaded area. It's area that you would have been paying in this particular plan little to no taxes, but by taking advantage of paying a lower tax bracket during that time, you see that we actually then later on in age 79 and above pay substantially lower amounts in the higher tax bracket. It can be a little hard to see, but there's that green shaded area behind that blue area. We see that it fills up substantially lower amounts of that higher tax bracket. So in this particular instance, this client would have been paying 25% tax on that blue area later on in life when they started taking minimum distributions. But because we filled up what is then the 15% tax bracket when they are age 64, they're able to pay a lot of that income at 15%. It's now in a Roth. It's growing tax-free. They only now have to withdraw it if they actually need it for their financial plan rather than being required to withdraw it by the IRS, and they're not paying that higher tax rate. So you can see that there's a fancy calculation there on the right that for this particular client, utilizing this strategy of paying taxes now versus paying them later results in about $660,000 more tax-adjusted ending portfolio value left to their heirs, which can be very substantial.
Yeah, for sure. And this is where I want to challenge folks that are listening to this video to see, okay, am I in this situation? Am I in a tax bracket this year that is lower than it's going to be in the future, or maybe just lower this year because of some circumstance? Maybe you just had extremely low income this year, or you just retired and now you're living off of taxable monies or just Social Security, and your bracket is significantly lower than it either has been in the past or will be in the future. Then you might want to start considering talking to us and engaging us in this situation, because this next slide will show what we really start to do for someone. So when we think about tax brackets, I wish I was good enough at Excel to make these red bars on the right-hand side like little glasses of water. So when we think about your tax bracket, it works like a glass of water. So you have all these tax brackets laid out, and there are cups. So a 10% cup, a 12% cup, a 22% cup, and a 24% cup. And as you have income, you fill each cup. So once your 10% cup is full, then you can start filling the 12% cup. Then you start filling the 22% cup. So you pay for this person who had about $90,000 in adjusted gross income. So you'll see this blue graph represents their income. They're not going to add up to 90,000 because they have standard deduction. So when we look at this, they filled up their 10% cup. They filled that up fully. So they'll pay 10% tax on that $20,550. Then they started filling up their 12% cup, but they didn't fill it up all the way. So that second 12% tax bracket has $63,000 total that they could fill up the 12% bracket. They only put 42,550, which means when we're looking at this and we're evaluating with a client, well, it might be a good opportunity to do Roth conversion, and you could potentially do as much as you want, but to optimize your tax bracket now, you could do about $20,000 worth of Roth conversion this year. which means when you do that, you say, okay, yes, I want to do $20,000 of Roth conversion. We're going to add more to this cup. So we're going to add $20,000 more to that cup. It's not earned income, but it goes on your taxes as income. We add that, and you have to pay the 12% taxes on that money that goes over and now converts from a traditional IRA to a Roth IRA. Daniel, anything
Certainly.
you want to
So
add there?
yeah, in this instance, we would obviously make sure that that particular client had $2,400 to pay those taxes, sitting in taxable accounts that wouldn't have to come out of those retirement accounts. That we're not paying taxes on the amount that we're sending out for taxes. That's very important. But if in this instance, if this client, for instance, had RMDs projected later on in their life that was going to bump them up to the next tax bracket, that's a big difference of savings that we're going to be able to have for them. So going up from that 12 to that 22% bracket, and that 22% bracket later on as the Tax Cuts and Job Acts expire, is going to be the 25% tax bracket. So we're looking at about a 13% tax saving dollar for dollar that this particular client is going to be able to have, assuming that they have those tax funds available to pay on this conversion. That's an excellent strategy, I think.
Yeah, and it's crucial what you said about if they go into the 22% tax bracket later on in life. Because if they're going to be in the 12% tax bracket, even throughout RMDs, then it might not make sense to do a conversion now. It might make sense to just continue along having the income that they have and not doing any conversion unless, and we're going to get there, planning for heirs or something along those lines. But you really have to look at, okay, here's where we are now, here's where our tax bracket's going to look like in the future. Should we make a move this year or next year or whatever that looks like?
Certainly.
All right. So we've hinted at it the whole time. What are the real benefits of doing these conversions?
Yeah, so we have the three top ones really listed here, and the three probably most important ones for most people, right? So no forced RMDs. If we get money into your Roth IRA, this means that you're going to be able to take those funds out on your schedule. So for those clients that we work with that can really fund their expenses via things like Social Security and pensions, or other assets, whether that's taxable accounts, or maybe even funds that they already have in Roth IRAs, et cetera. This gets more funds into the Roth IRAs that are not then forced to be taken out. So they stay in those tax advantage funds, which then leads to the next point, right? Better tax management. So later on in retirement, if you're thinking of things like large purchases, maintenance on the house, or second house, or vacations, dream things that you want to do, or just simply medical needs, years that medical expenses are higher than expected. This allows you to take those funds out of the Roth IRA, significant amounts sometimes in some years, and not be taxed on those, rather than if you had taken out tens of thousands of dollars out of an IRA in a single year, you now may be bumping yourself up into a higher tax bracket. And finally, we'll go into this one in a little bit more detail, but quite simply, your kids or heirs are just going to love you a lot more if you do this.
Yeah, I mean, when we look at the children planning, this is a crucial component to these Roth conversions because if something happened to you, you pass away, you and your spouse, or yourself, and you pass that on to non-spousal heirs, well, then they are required to take out that inherited IRA within 10 years. And for most people, if their parents or something may pass, they may be in a high tax bracket. You may be in a 30 to 40% tax bracket there whenever your parents pass, those prime earning years, like you say. And in those years, you have to take out those funds within a 10-year time period, and you're going to pay significant taxes on that. But if you're doing a Roth and you have that money in a Roth, well, then you don't have to worry about paying taxes in that time period.
Yeah, so let's break that down. Most people, I mean, most retirement accounts we see do list kids as their beneficiaries, right? In some cases, maybe it's grandkids. In some cases, it might be charities. But generally speaking, I'd say 80% of the time we see children as the beneficiaries. And so let's think about that for a moment. IRS life expectancies are usually around mid 80s for most individuals. Now, the actual statistical life expectancy, like when we run a plan or something, we're going to plan out to say the 90s. But as far as, say, IRS and financial schematics are concerned, mid 80s. So back that mid 80s would put your children in 50 to 65 years old, around the time that you pass away. For most individuals, that's not retired yet. That's in their prime earning years. And for a lot of folks, that might mean that their own kids, i.e., tax deductions, are now aged out of being tax deductions, are out of the house. And so they are in their highest earning years, hopefully with a paid off house because they've financially planned well. You've taught them well. They have minimal tax deductions in their own life. And now they're receiving these inherited IRAs that must be distributed fairly quickly by historical standards and done so at a taxable rate. So, because of that, if you add in federal taxes, state taxes, on top of their current income, you could see about a third of the value of those IRAs that they've inherited being lost simply taxes, which is pretty substantial.
Yeah, we've had clients actually come and talk to us and say, "Hey, I'm not really your typical case for a Roth conversion. I'm going to have pretty much the same tax bracket for the rest of my life, but I'd like to start putting money into a Roth to help out my heirs in the future." So I think it's a really important strategy, and it's an important thing to consider when you're talking about Roth conversion. All right, Daniel, this is a big one because we've had a lot of people reach out to us that said, okay, does this make sense for me? I want to do Roth conversion, but it doesn't. Or we've seen people that have done Roth conversions in the past. And it's like, I really wouldn't have done that year. So what is it when it doesn't make sense?
Yeah, so these are going to be the three biggest ones. If any of these make sense for you, I would yield. I wouldn't necessarily stop, but I would definitely yield. Talk to us, talk to your advisor, and make sure that it makes sense to proceed. So if you do not have cash available for taxes outside of your retirement account, then we really want to be careful and run the numbers on that, because what that means is you need to take extra out of your IRA in order to be able to pay the taxes. That means that you're paying tax on the amount that you're taking out to pay tax, because you're taxed on the total amount that you take out of your IRA, not just the net amount that you hold on to. It's just like a paycheck. When you get a paycheck, you're taxed on the gross amount that you get paid, not on the net amount that you receive. Sometimes people get a little bit confused on that when it comes to retirement accounts, but keep in mind, it's the total amount coming out of the account that you get paid on or that you get taxed on. So the best option is to have cash available outside in savings accounts and investment accounts, et cetera, that we can pay the taxes off via. Also, if your tax bracket is going to be lower in the future and you're not thinking through things like heirs, et cetera, then it generally is not going to make sense to pay that higher tax amount now. We would really have to run the numbers and understand why that would make sense for you. And in very few cases does it make sense to pay substantially more tax now than it would in the future, assuming, again, all things considered and what we know today about tax brackets carries forward into the future. And lastly, if you do have charities as your beneficiaries rather than kids, then it definitely does not make sense to convert that to a Roth. The reason is you're going to pay taxes on that now. You're going to put it into a Roth, and the charity will not pay taxes on it. However, if you left it in the IRA and the charity inherited it, the charity would not pay taxes on it. So you're just actually doing a disservice to the charity by converting that to a Roth, because you're actually removing funds that they would otherwise have been able to receive. So in those three instances, we either want to slow down or just stop altogether.
Yeah, for sure. All right. So that's the basic gist of it. I mean, it's pretty simple, but it is unique to you. So this is the most important part. If you think remotely that you're interested in a Roth conversion, that you just want to learn more, maybe you just want to put it on put it on our plate to say, hey, we might want to do a Roth conversion at age 60 because we know our income is going to fall significantly at that point. If you have those things, you have questions, feel free to email us at info@jewelfinancial.com. Shoot us over an email. Just say, hey, I'm interested in learning more about this. We have some additional questions to send you. One of the first things that Daniel and myself do whenever we start talking about conversion is we look at your 2021 tax return. So we dive into that. We look at what all taxes you had last year, what deductions you're getting first, and then we start looking at the income for this year, any additional income, and then we can start running scenarios. Daniel, what else do you have for folks, and how can they best use us as a resource?
Yeah, so if we've been doing financial planning for you and you're in sort of our online financial planning system, this is something that we can look at pretty easily. If we're starting from scratch, again, we're going to have to look at your tax return. We're going to have to get some more information. I would say we need that information by December 15th of this year if you are thinking about doing a Roth conversion this year. If you're thinking about doing it sometime in the future, then it can be an ongoing conversation. But keep in mind, there is an end of year deadline for 2022 and actually every subsequent year. But if you're wanting to do it in 2022, there's a very firm end of 2022 deadline that we have to make sure we hit. So if it's remotely interested to you, I would email us sooner rather than later and get that process started.
Perfect. All right, guys, we're going to wrap it up here. Thank you, Daniel. I like doing that. That was fun. That was fun to get to go through a little bit of some details and some data.
Yeah, we'll see how these on-demand webinars take off, and if people really enjoyed it, be sure to you can actually email us at info@jewel.financial. Let us know. Even if you're not doing a conversion, if you like this format, and if there's other topics that you want to see us address or questions that you have in mind that you want us to do a deep dive on, about 20 to 30 minutes, we're happy to do on-demand webinars about the topics that mean the most to you.
Perfect. All right. Thank you all so much. Have a good one.